All right, why don't we go ahead and get started? So thank you guys very much for joining. Quick introduction. My name is Mark Lamonic. I look after the individual investor team for Morningstar here in Australia. We got to go through a couple of housekeeping items first. So number one, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. Also, if you're over in New Zealand, you want a copy of our FAP, you can go to our website, morningstar.com.au, and get a copy of that. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. All right, so feels strange that this is the first one of the week, even though it's Thursday, but hopefully everybody enjoyed the Melbourne Cup on Tuesday. I personally missed it, but I hear there's a horse race. All right, let's do this. So today we're going to talk about how to select investments. We're going to talk about two different things because this obviously is a very big topic. We're going to talk about shares and the different things you can look at when trying to select a share. And we're going to talk about passive investing. So we're going to talk about how you would go out and select a passive fund or a passive ETF. So yeah, those are the topics we'll cover. Obviously, any questions would be appreciated. So if you have any questions, hit the Q&A or put them into the chat. All right, let's talk about shares first. Then we'll get into passive ETFs and funds. So we got this quote from Buffett. So obviously you guys can read it. A little bit of background. So Buffett's investing approach has changed over time. He used to be kind of a pure Ben Graham value investor, evolved into somebody that was really looking to buy great companies. So we've got this quote: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So we're going to try to explore this quote a little bit, talk about what all of this means. So let's start with a wonderful company. So what is a wonderful company? Well, a wonderful company is a company that has a sustainable competitive advantage. So that obviously is this concept of moat, and it's the concept of moat rating with that Morningstar analysts provide, but we'll talk a little bit about what else that means. So what is a moat? So moat, sustainable competitive advantage. What that means is that a company is able to withstand competitors that are trying to essentially copy it and take market share or take margin from that company. And we'll talk a little bit about sort of capitalism in general and how that works in a second. But that is that's a moat rating, right? So if you can maintain the sustainable competitive advantage, lots of good things happen to you as a company, which we'll get into. All right. So how does this whole moat concept work? Well, the very simplistic explanation is that capitalism, of course, means competition. If it works correctly, it means that competition should benefit you as a consumer. So it should benefit you as a consumer because you will have better products that are created, that as companies are creating better products to try to win you as a buyer, and it should result in lower prices. So that's very good for you as a consumer. That's not great for you as an investor, right? So we don't want prices to be lowered. That will lower the margin or the amount of all the sales that we get to keep as a company and as shareholders and owners of a company. And that will also mean potentially market share goes away, which is also not good, right? Either way, your sales are going down. If you're selling stuff for cheaper or you're selling less of it, that's not a good thing for a company. So the idea behind a sustainable competitive advantage is that even with all of these competitive forces that are happening in capitalism, that the company is still able to maintain an edge over that competition. And how does that, and we'll go into some of the specifics about this in a second, but how does that translate? How can you look for your own moats? So our analysts, of course, cover 1,600 global shares. But, there's 45,000 publicly traded shares in the world. How can you find moats? Well, moats, there are signs of moats that show up when you start looking at the financials of a company. And there's a lot of different things that you can look at, but there's two big ones. So return on invested capital is one and margins the other. There are different margins. which we'll talk about in a second. But let's start with return on invested capital. So what does that mean? It basically reflects, it's a measure, it's a financial measure that reflects a company's ability to create value for shareholders. So that means the capital that's invested in the company. So capital comes from shareholders. Certainly, it comes from debt. That's another way to raise capital, and also just internally generated funds as well. But if we're looking at return on invested capital, we are basically, a shortcut for it is we're taking net income, so how much the company makes. We are taking out dividends, and we're dividing it by debt and equity added together, which you can find on the balance sheet. So intuitively, what this provides you, and you can find this everywhere. You don't need to calculate it yourself. It's on our websites, it's on lots of other websites. But sustaining a high return on invested capital means that the capital that's getting invested in a firm is earning a high return that exceeds the cost of capital. So let's think about cost of capital and how this whole thing comes together. So as a company, of course, I have to pay money to get capital. If the simple example is that if I issue a bond, if I'm trying to raise debt capital, or if I go to a bank and I borrow money, I have to pay for that. I pay interest. So there's a cost associated with it. There's also a cost associated with raising equity capital, that if I'm selling additional ownership stakes, the current owners own less of the company. That's why we don't like capital raisings. We don't like equity capital raisings as shareholders, unless that can be invested well. So simple example to think about that is if I own my own business and I need money to open, let's say, a second store of my business, well, I can go out and take on a business partner. And that business partner, he or she, will give me money. And the money goes into the business and I can use to expand to a second store, but they're going to take ownership. So that's not great for me, right? I now own 50% of the company if I give them an equal share. But if I can invest that capital, if this other store that I get works out, then it could be ultimately beneficial. So that's what we're trying to look for. Companies that earn a return on invested capital that is well beyond their cost of capital. It means they can go out there and keep raising money and keep expanding the business and earning excess returns for shareholders. So that's one way. And what I would say with the return on invested capital in any of these measures, don't look at 1 year. Look at least a 5-year period and see how high these are. So anything can happen in 1 year. There can be a lot of noise. We want companies that can sustain this over the long term. Because what you could potentially see is when a company is a startup, you could see very high returns on invested capital until somebody comes in and copies them. Right. So every great idea, if you're Afterpay and you came up with this new idea, well, now there's like 50 buy now, pay later competitors, right? People are going to come copy you. That's capitalism. So it's the ability to fend off that competition. So margin is the other one. So basically margin just looks at, and there are different measures and we'll talk about them in a second, but it just looks at, all right, how much of every dollar that you sell a good for do you get to keep? Does the company get to keep? Does shareholders get to keep? So very simple, a 50% margin means that if I go out and sell something for $1, I make a 50-cent profit. So all the other expenses that I have that are associated with whatever I'm selling, cost to create it, cost to market it, the cost to distribute it, the cost to pay people for the company, everything else comes out, I make 50 cents. So you'll hear a lot when people are talking about companies, they'll talk about the top line and they'll talk about the bottom line. So the top line is revenue, sales. The bottom line is profits. So both of those will generally be a lot higher with companies with moats, because in both cases, you'll see these things erode as competition happens. So the margin one's pretty simple, that if I go out there and I'm creating this generic good that I'm selling for $1, and I have a competitor that comes out, I'm making a 50% margin, and I have a competitor come out that undercuts me on price, what am I going to do? Well, generally, I'm probably going to reduce my prices. So those are two indications that a company is doing well. All right, we've got a question saying, what is moat? So moat refers to a sustainable competitive advantage. So if we think about a castle, and this is a term that was popularized by Warren Buffett. So when he's talking about a wonderful company, he's talking about companies with moats. So we think about a castle back in the Middle Ages. What do they have to protect it? A moat. So a sustainable competitive advantage protects a company. So our analysts have something called a moat rating, where they look at all the companies under their research coverage, and they will assign it either a wide moat or a narrow moat. So a wide moat are sustainable competitive advantages that they believe will last for more than 10 years. A narrow moat, more than 20 years. A narrow moat is more than 10 years. So moat is a Morningstar rating. It is also just a term that obviously Buffett came up with that's very popular in the industry. So most investors, you'll hear them talking about moats. This is a moaty company. So what that means is they have a sustainable competitive advantage. So let's explore where moats come from. So this will hopefully take this from conceptual to something a little more concrete. So at Morningstar, we've identified 5 different sources of moats. So that is why, right? We talked about what a competitive advantage is, but now we got to talk about why a company has a competitive advantage. Let's start with, and we'll go through these examples, and I can try to give a couple more too. Let's talk about intangible assets. So an intangible asset, and once again, this is like a little bit of a finance term. An intangible asset is an asset of a company that doesn't show up on the balance sheet. So a balance sheet is simply an accounting for everything the company has and everything the company owes. So what they have could be land or a building, or if you're Qantas, an airplane, things the company owns. And then we have debt and things the company owes. So if we owe money, so that's a balance sheet. It's just a snapshot of, at a certain point in time, what a company has and what they owe. So same thing that if you did your own balance sheet, you could sit there and say, I've got $10,000 in the bank and I've got $5,000 in credit card debt. So what do I have? What's my net worth? In that case, it's $5,000. Now, an intangible asset is something that isn't on the balance sheet, something that we can't account for, but something that still is really important to a company. So we've got examples in here. A brand, right? There's no, we have Coca-Cola as an example. So Coca-Cola has spent 120 years building this brand. They've been building this through advertising. They've been building this through consistency and quality of a product. That brand doesn't sit on the balance sheet. So if I'm only looking at financial statements to evaluate a company, the brand doesn't show up. So if you had Coke and you had Mark's soft drink, you could look at the balance sheets and try to evaluate them, but nobody wants my drink, right? Lots of people all over the world want Coke. It's an example of a brand. So it's very hard for people to compete against a brand, a long-established brand that has consumer trust. A patent. So a patent is something that does not show up on the balance sheet. It's an intangible asset, but that is a legally enforceable mechanism to prevent people from copying you. Right. So just as we said that capitalism is competition, governments have decided in certain cases we don't want competition. Right. Like with pharmaceuticals, for example, we want to make sure that a company will invest the sometimes billions of dollars that it takes to develop a life-saving drug. So what does a government do to encourage that? They say that, OK, if you invent this drug for 10 years, nobody can copy you, that you're the only one that can sell this drug. So that's a patent. And a patent also obviously doesn't just have to be in a pharmaceutical. It could be on a piece of technology, anything else that you can create a patent on. It's supposed to encourage innovation, encourage investment in innovation. But once a company has something that is patented, that is an advantage for them because nobody can copy them. Government license is also a way. We just released a podcast on Sunday that talks about infrastructure. So in infrastructure, governments will issue licenses, which once again encourages somebody to invest. So, simple examples that we talked about on that podcast is Transurban, for example. State governments have decided that they don't want to spend a bunch of money building a new road. or they want to sell a road that they already built. And how do they encourage somebody like Transurban to come in and buy that road and operate it for them? Well, they give them a long license to operate that road. So Transurban, I believe, has around an average of all the different roads they own of 30 years, right? So the government's saying, you build this road or you pay us for this. For 30 years, you can exclusively operate it. So government license can also be a form of moat, intangible asset. Casino licenses is another example, right? For years, there was one casino in Sydney, right? So the Star Casino had an exclusive license to operate a casino in Sydney, and that's obviously very valuable because there can't be competition. Now, then the government issued another license right over there to the Crown, and of course, then took it away. But still, that's an example of how governments can license certain things, and it is a moat. Cost advantage. So cost advantage obviously is a competitive advantage. If I can produce something for cheaper than my competitor, it gives me two choices. Number one, I can undercut my competitor to the point where I could effectively drive them out of business if I wanted to do that. So I can sell something for cheaper and make the same margin if I sell something for cheaper, or I can sell it for the same amount as my competitor and make a higher margin because I have a cost advantage. Generally, cost advantages come, as it says in here, from economies of scale, right? So, and we all remember this term, or maybe remember this term, but economies of scale just means that, hey, if I'm producing 1 million bottles of water, it's going to be a lot cheaper for me to do that than if I'm producing 1,000 bottles of water, right? Because I can go out there and negotiate better with suppliers, all sorts of advantages that I have. So that's cost advantage. Now, Amazon, it's a sort of Amazon strategy, right? So Amazon in Australia, not quite there in Australia, but you go to the US and you can buy toilet paper on Amazon for cheaper than if you go off to the food store. Why? Because they built this incredible network of distribution centers, and they're effectively going out there and undercutting. And their strategy deliberately is to undercut people, grow revenue, even if it's not growing profits, because they're selling stuff for so cheap, and basically put a bunch of people out of business, whether they'll say that or not. That's sort of what Amazon is doing. So switching costs is another moat. Switching costs basically means sometimes it's a pain in the ass to switch from one provider to another. And the classic example we always use is banks, right? So you set up a bank account and all your friends are in there, you can pay them, and all your bills are set up so that you pay them out of your bank account, and you've got your direct deposit from your job going into your bank account, and then maybe you have a mortgage attached to your bank account. It's a big pain to switch. So even if a competitor, if I'm a CBA customer, even if a competitor is offering slightly higher interest rate or slightly lower fees, it has to be worth my while, my time commitment to go in there and change all of this stuff, get a new debit card, and the drill. So that is a competitive advantage, switching costs. Network effect. So network effect, and we always use the same example for network effect, but Facebook is a good example. So basically the network effect, as you can read on here, means that the value of a good or service increases the more people that are on there, right? So why do people go on social media? They go on there to be quote unquote social, if you can be social through your phone. If you're the only person on Instagram, it's probably not that much fun, right? So you can post your pictures and nobody will see them. And you go on there every day to see if anything's on there, and there's nothing on there, right? So the more people that this network gets, the better off it is. And that's why you see with a lot of businesses that involve network effects, it's hard in the beginning to sort of get to that critical mass. So that's network effect. And of course, Facebook is an example. Efficient scale is always one, I think, that confuses people. But if you are a big fish in a little pond at the end of the day, and it doesn't really make sense because the profits aren't enough for somebody to compete with you. So I use Enterprise Products Partners as one. That's a oil pipeline company in North America. And basically, if you set up an oil pipeline that goes from a port in Texas to I don't know, making up a city, to St. Louis, and you can supply all the oil that they need. Is somebody else really going to build another pipeline? Like, what's the point? The profit is not big enough to justify the cost in doing that. There are also pharmaceutical examples in here. Like if you come up with a treatment for a disease that not very many people have. So, 10,000 people around the world are afflicted with a disease every year, and you've created a drug that treats it. Is somebody really going to spend all the time, even when your patent's over, developing a rival drug? No, because the profit is not big enough, right? Because it's a very limited market. So those are some moat sources. So Paul's saying he's calling it the trapdoor moat. I really like that. He's talking about accounting software as well, right? So it's one of those things, right? If I spend all of my time putting a bunch of stuff into accounting software and has all of my history and everything else, am I really going to switch? It's going to be a huge pain for me to switch. So the benefit of me switching is going to have to be pretty high. So that's a really good example, Paul. All right. So those are moats. Now we have to talk about fair price for a wonderful company. So Buffett makes a distinction in this quote between a wonderful price and a fair price. And once again, all of this hopefully is representative of being students of business. Right? So if we are going out and we are buying shares, we should be students of business, because that's what we're doing. We're buying businesses. We're becoming owners of businesses. So let's talk about, fair price. People fall into the trap, and they call it the value trap. People fall into the trap of just going out there and trying to buy the cheapest thing possible. And one of the things that we always talk about, and cheap in terms of, and the way people generally will measure cheap, is a simple thing. Like they go and they look at one of these relative valuation measures, like a price to earnings ratio, a price to book ratio, et cetera. So they fall into this trap where they go out there and they say, okay, I don't want to overpay for something, which is very important from an investing standpoint. So I'll just go buy the cheapest stuff. Problem is, sometimes stuff is cheap for a reason. So that's what we're saying. Be very careful when comparing a relative valuation measure. Context is critical. So that's why our analysts calculate a fair value, and they do that through a discounted cash flow measure. But what that does is looking at what is the potential future of the company? What are the cash flows that they can generate into the future? And that's why they use that as a valuation technique. But I want to use an example here. I took two companies. So both American companies, but I think people, at the very least, obviously, have hopefully heard of Microsoft. So let's start. I should have put this in a different order. Let's start with price to earnings. So if I just go and look at price to earnings, I can see that Microsoft is much more expensive than Delta. So if I fall into a value trap, I could sit there and say, okay, well, I will buy Delta. It's cheaper. Cheap is good. I want to buy cheap companies. And you see, even with the forward earnings, it's cheaper as well. So that includes sort of where we're going into the future based on analyst estimates out for the next year. So this must be a good thing. I should definitely buy Delta. Well, no. All right. So this is where we look at what is a wonderful company, what's not a wonderful company. How does price play a role in that? So Delta is a very different company than Microsoft. Now, whether Microsoft right now is priced attractively or not, or whether Delta is cheap enough to justify that, that's what you need to decide. That's what investors need to decide. But we start looking at some different measures between the two. Return on invested capital, way higher for Microsoft. And there's this famous quote that I think Buffett said as well. We'll just go with Buffett quotes today, that if you want to make a small fortune, then take a big fortune and buy an airline, and then you'll have a small fortune. So notoriously costly business. There's fuel, there's the planes, everyone goes on strike, like very tight margins. That's what he's talking about. So return on invested capital. So borrowing money from banks or from debt holders, raising capital from shareholders, not very high. All right. And remember, when we think about that return on invested capital, we are thinking about we want that to be higher and hopefully significantly higher than our cost of capital. I don't know what Delta's cost of capital is, but it might be higher than that, right? 6.5%. Whereas Microsoft, really high, over 20%, a lot better. Operating margin, and I've gone back 5 years in each one of these and looked at the last 5 years, right? Because we want to take a more representative sample. Operating margin. So operating margin is simply looking at there's lots of different margins. So operating margin basically means let's take all the variable cost of producing a good. All right. So if I'm making a pie and I'm selling it for $5 and the cost of making that pie, just that pie is $2, and okay, that is my operating margin. So it doesn't count all the stuff that doesn't go into that pie. But just looking at that individual thing. So for every dollar of sales that Microsoft makes, their operating margin is over 33%. They get to keep over 33% of that. So that means as they continue to expand, if they're increasing, this is why we look at operating margin. We've got some fixed set costs, but as Microsoft grows into the future, they get to keep 33% of every additional sale that they make. So that way I know that if this is a company that's growing, that I'm going to keep a lot as shareholder. And tech companies obviously are notoriously scalable. It doesn't take a lot of people, it doesn't take factories, it doesn't take any of that stuff. It's just some people writing code and then selling it off. So, and that code can be sold to 10 people or 1 million people at pretty much the same cost. So that's why you're getting these high operating margins. Delta, not very good. Especially in a business like an airline where you have very high fixed costs. So that's really bad. So once again, Microsoft, a lot better than Delta. Debt to equity. So what we're looking at is what is the percentage, if we look at on the balance sheet, debt, what we borrowed, equity, shareholder capital, divide the two together. This is really good. Means they don't have a lot of debt, means they have a lot of financial flexibility, means there's less of a chance of them going out of business in any sort of bad scenario where they can't pay back their debt. This is really, really high. And obviously they're different businesses and this makes sense, but this is an example of why you want to look at the context and look at how great of a business something is when making any one of these comparisons. Now, I will say obviously that I picked two easy ones for this to make this point. As I said, people love tech companies because they're very, very scalable, because they are asset light companies. I mean, they don't have to invest in a lot of assets. Airlines are asset heavy companies because if I want to start a new route, what do I need? I need a plane. So that is an asset that I have to go out there and buy. That's an asset that depreciates. That means I have to replace it at a certain point. So people love tech companies, less so for old school, kind of more industrial companies. Now, doesn't mean that there isn't a good price, and I'm not making a judgment on what Delta is trading at right now, but doesn't mean there's not a good price that you'd want to buy that company. But if we were going to buy a wonderful company, the wonderful company is Microsoft. Now, you have to be careful you don't pay too much, but you do need to take that context into account. Let's see. Paul's getting all sorts of trapdoor companies. Yeah, he's talking about Canon and Nikon. Pro Gear, no cross compatibility of equipment. So we'll have to talk to Will about that. We have a Canon camera right here. All right, so Lisa has a question. Is there a benefit in restricting our suite of companies, say 10 to 15 in our portfolio, or is there a suggested maximum number of individual companies to hold? Yeah, okay, so let's talk a little bit about that. That's a great question from Lisa. I don't know if the Alpacas enjoy the Melvin Cup. I don't know, horse and alpaca, if they get along, but and Lisa has alpacas for anyone that's new to this. Okay, so let's talk about how many companies we should hold. So I'm taking the question to mean that you don't hold anything other than these companies. So we'll sort of talk about that. When we are trying to diversify, there are two types of risk, right? There's systemic risk and there's unsystemic risk. So systemic risk, think of systemic risk as just the risk that we're going to have to face no matter what as equity holders. So as investors, we go out there, we take on risk, and by taking on that risk, we expect to be rewarded with returns. So we're always going to have that risk. Whether I go buy a index fund that has 1,000 companies in it, or I go buy one company, I'm always going to be affected by the systemic risk. The risk that the economy may not do very well, the risk that there could be higher interest rates, higher inflation, all those sort of risks we take on as investors. Unsystemic risk is related specifically to a company. So an unsystemic risk says that if I'm Delta Airlines versus Qantas, that something bad happens at Delta. Well, the perfect example is in Australia. You've got Qantas and you've got Virgin, right? So buying a single company gets you unsystemic risk that something bad could happen to that company, could go out of business or just do poorly. So in Virgin's case, it went out of business, right? So that was a risk directly related to the company, basically the company having too much debt. So the same systemic risk hit both companies, COVID. One company went out of business because of very specific things related to that company. In fact, they had way too much debt. So that's an example of systemic risk and unsystemic risk. So when we diversify away in our portfolio, we're diversifying away that unsystemic risk. And we can obviously do that to varying degrees. So there have been there have been surveys that have gone out and sort of looked at what it would take in terms of if you're just buying individual companies to diversify away that unsystemic risk. And yeah, most of them said it's in the 20s. You can diversify away most of that unsystemic company-specific risk. Now, of course, if you're buying like an ETF that holds 500 companies, you kind of done that on your own. So yeah, hopefully that answered your question, Lisa. Okay, so Jennifer is saying, why does the Morningstar fair value change? So the fair value, to go back, here's our fair value at InvoCare, so 1530. Our analyst, Angus, thinks that InvoCare is worth $15.30. So why would that number change? Well, that number would change if our analysts, if something happens that causes our analysts to change their model. So that could be, so InvoCare is a funeral operator. I don't know why I always use it as an example. Maybe it's just a little bit morbid, but yeah. So let's talk about COVID again, since that's all we ever talk about. So COVID happens. All of a sudden, they limit the amount of people that can go to a funeral. And shockingly, we all get a lot healthier because nobody's leaving their house. So what happens? The death rate's gone down in Australia. The ability to go out there and have a funeral, which somebody would pay for, is limited because you can't have that many people in a room in a lot of states. So that was very bad for InvoCare. So what our analysts would do is they'd say, okay, I look out at my model. How long is COVID going to last? What are those impacts going to be? They're going to adjust those cash flows down. And that's an opportunity for InvoCare. Sure, that's a situation where InvoCare loses market share. Another opportunity on the upside is something has happened in the economy or with a specific company that causes our analysts to believe, okay, I think this company is going to make more money in the future. So they'd increase those future cash flows, and that would raise that fair value. So anytime you see a fair value change, it means that something's happened, that the company has reported something that the analyst thinks will change their future prospects. There's been an economic event that potentially could change the overall economic growth, could change the balance between two different companies, that one company may gain some more market share. Those are all the things that could change a fair value. So basically anything that could change the future prospects of a company. All right, last one for shares. We're going to talk about a margin of safety, and we're going to talk about uncertainty rating. So another rating that our analysts have is something called the uncertainty rating. So remember, when our analysts are calculating the fair value on a share, They are projecting cash flows out into the future. Now, the future, of course, is unknowable. None of us know what's going to happen an hour from now, let alone tomorrow, let alone 10 years from now. So we all need to go in there with this intellectual humility that we cannot predict the future. So some futures are more predictable than other futures. Like I can tell you, obviously anything can happen, that when this thing ends in 20 minutes, I'm going to go get the Coke Zero that I bought before this and drink it and go to a meeting. Now, anything can happen. This building can fall down, and that, of course, wouldn't happen. But it's easier for me to predict, of course, something that's going to happen in 25 minutes than it is for me to tell you what I'm going to be doing in 10 years. So there are different levels of predictability based on the company. Maybe my example is a little dumb because we're not talking about just time. But if a company is in great financial shape, if a company operates in a very boring industry, they are making Coke instead of cutting edge biotech, right? Like all of boring, safe financially, boring industry, being very safe financially, all of that equals low business risk, right? Versus high business risk is if I have a ton of debt, if I'm operating in an industry where technology is continually changing, so I'm trying to invent a new drug, so are 50 other little biotechs out there, somebody's going to make it, somebody won't. Loser will go out of business. The winner will make a ton of money. That's very high uncertainty. So our analysts are trying to assess based on the industry, based on the countries potentially they're operating in, based on the financial position of the company, what the predictability of those future cash flows. How sure are they that their model is right at the end of the day? So they're going to assign different companies different uncertainty ratings. Now, how does that translate into us as an investor? It translates into a concept known as the margin of safety. The margin of safety means that I want a buffer between what I think something is worth and what I'm willing to pay for it. And I want that buffer for a couple of reasons. I want the buffer, number one, because I need to be, intellectually, I do need to have some humility and realize that my predictions of the future may be wrong. Number two, because we know anything could happen, right? COVID happened, then COVID mutated, all stuff that was very unpredictable at the end of 2019, right? We know stuff's going to happen. So we want to build in a margin of safety to account for the fact that the future is unknowable and my predictions about the future could obviously change. So or could not come true. So how do we build in that margin of safety? We build it in based on the percentage that we will take that we want from a discount perspective between the fair value and what we want to pay for a company. So I'll just use two examples. So low 5-star stocks represent the biggest discount between what a company is trading for and what its fair value is, as estimated by our analysts. So 5-star stock. Here we're saying, all right, if we want to give you a 5-star rating on a share, we'll take it if it's 20% undervalued. So if this thing is 20.1% undervalued, we'll say it's a 5-star stock. So it's 20% below our fair value. However, if we get to the extreme level where we're saying the company's future is very unpredictable, operates in an industry that's really risky, we want to take a bigger margin of safety. So we're saying 75%, which is a ton, right? So this thing, if we think it's worth $1, this thing has to be trading for 24 cents before we give it a 5-star rating. So that represents that uncertainty. So remember, once again, as we're students of business, we need to admit that some companies are riskier than others. Go back to that Qantas Virgin example, same industry. They're basically doing the exact same thing, or they are doing the exact same thing. One company was riskier because it had a ton of debt. And that's something the company did. They put themselves in that position. Just like if you had a ton of debt and somebody had the exact same job as you that had no debt, well, who's going to be in bigger trouble when they lose their job? Person with a ton of debt and no savings versus somebody who has a lot of savings. So that's an example of margin of safety and uncertainty, and acknowledging that there are different business risks. Not all companies are the same. Not all industries are the same. Investing in different countries, not all countries are the same. So just something we need to be cognizant of. Yeah, so Grant's saying using these techniques to buy shares is great. And I guess you should also use it to know when to sell rather than becoming a long-term investor in a dog. Yeah, so that's this sort of notion of a value trap that, we go out there and we buy crappy companies because they look cheap. And I think I think a lot of this, right? Like a lot of this is just as investors, we need to buy things that make sense for us. So they make sense for what we're trying to accomplish from a goals perspective, and they also make sense in terms of our temperament and the way that we're comfortable investing. Right. So, if we want to take an extreme example is like Bitcoin, right? So Bitcoin is highly, highly volatile. I'm not saying that it's not going to go up potentially. I also have no idea where it's going to go, but you need to be prepared for a lot of very wild swings if you're a Bitcoin investor. And if you can't handle that from a temperament standpoint, then you shouldn't invest in it. Because the problem is that means when it goes down, you're going to freak out and sell. So same thing if we're just looking at shares. You want to invest in safe shares. Safe in terms of low business risk. Now, potentially your returns on the upside is not as great. If I go out and I buy, and I think we use this example all the time, if I go out and buy Coke, all right, steady company, is Coke going to triple in price next year? No, very unlikely. I go out and buy some speculative miner that's trying to strike the mother lode in WA. Well, hey, I could make a ton of money if that happens. I could also lose all my money if it goes out of business. So we just need to understand that shares are not all created equally because companies are not all created equally. Some things are more risky than others. Now, that doesn't mean that you shouldn't invest in riskier companies. Or should invest in safe companies, depending upon your point of view. But it's just going in with your eyes wide open about what you're actually investing in. So Jennifer's saying, given that the fair value is quite changeable, what value is it for assessing a company? Yeah, I mean, it is changeable because circumstances change, right? So it's not like we can set a fair value and then never have it change. I do understand that it can be frustrating if you buy something and then the fair value changes, particularly if we lower it. But we have to change it, right? So what's that old quote that I change my opinion when the circumstances change, right? Like we need to understand that things change in the world. Like businesses it's very dynamic, right? The economy is very dynamic. It's what we say we all like, that sometimes things are going to do well, sometimes they're not going to do well. So that's what our analysts need to do. So they're not going to get it right all the time, but sort of anchoring it around that fair value, anchoring around the fact that as investors, we need to understand whether we're taking a third party telling us what something is worth, or whether we're calculating it ourselves, or whether we're just estimating something and looking what goes into those calculations. We do need to reflect upon the fact that this is a business and a business has a value. So Grant's saying on ComSec, so I'm going to take your word for it. The Morningstar fair value for WES is $39.50. The current price is $59.13. And the recommendation is sell. However, analyst consensus is hold. How do you reconcile which recommendation to follow? Yeah, I mean, listen, what I would say is that once again, what are analysts trying to do? They're trying to predict the future here. That's not easy. And there's going to be different opinions. So what I would do, I'm not going to sit there and say, because I work here, that just follow Morningstar. What I would do is dig into it a little bit and look at where that estimate comes from. And what are the drivers in there? That's what I always tell people about our analyst report, that you shouldn't just go look at the conclusion of our analysts. You should read why they think that. And then you're all smart people. Figure out if you think that makes sense, right? Like Tesla is a perfect example, right? That, we have a fair value that's well below what it's trading for. And there are people that think Tesla is the best company ever. Now, I'm not saying we're right. I'm not saying they're right. What I am saying is there are assumptions that go into that. So if you go in and read our analyst report on Tesla, our analyst will talk about how many cars he thinks a Tesla is going to sell. You know, the tweets that you get from Elon Musk are well above what our analyst thinks they're going to sell in 10 years. Now, who are you going to believe? That's the determination you need to make as an analyst. Tesla sells cars. They sell more cars, they're going to do better and they're worth more. So read our analyst's argument about why he thinks they will sell X amount of cars and make a decision whether you think that's feasible or not. So, you know, the whole point of what our analysts do at Morningstar is supposed to give you tools to do things like, right, you guys are the investors, you're investing for your future, use the different tools that you get. So that's me on my soapbox. So Paul says, does Morningstar Premium only provide analysis for ASX local shares? What would be good to have access to US leaders too? Yeah, no, Paul, we have access to everything that our analysts cover. So 1,600 global shares that our analysts cover around the world. So North America, Europe, Asia. So yeah, you get access to it all. So see if I'm on a really inappropriate website. No, this one's not too bad. Although, all right. So if I change this, so if I go onto our website, am I sharing this? Yes, looks like I am. Yeah. So I was talking about Microsoft as an example. Sorry, there's lots of things all over my screen. All right, so if I talk about Microsoft as an example, so Microsoft obviously is a US company. So if we want to go in and look at Microsoft or anything else that we cover, there we go, 3 stars, that's the price. As soon as this thing pops up, we will see there's the analysis, there's our fair value. This is what our analyst has to say. So they upped the fair value to 345, and you read about why that happened. So that's that's our analysts covering all sorts of global shares. All right, we've got another. Is it risky to invest in lithium mining companies? Okay, well, that's obviously a pretty broad question. So, and I can't answer that directly, but I will say a couple of things to think about with lithium. So obviously lithium is really popular right now because the notion is pretty simple that we're moving to electric vehicles and other battery. We're going to use batteries more to make the world a better place and rely less on gas or petrol, for example, in cars that impact the environment. So a lot of people have sort of made this leap. Okay, lithium is a great thing to invest in. The 2 things I'd say that you should think about from a lithium investment perspective, and we're looking outside of the individual companies and the risks associated with that company. So 2 things. Number 1, do we think the future upside for lithium is priced into lithium already? So what that means is that people buy shares because of their expectations of what the future are, whatever their individual expectations are, but the consensus represents the price that a share sells for, right? That's a marketplace. These prices are set by supply and demand. So that means whatever price something's trading for may not be the fair value, but what it does represent is people's consensus view of the future. So if everybody in the world says that lithium is going to be the greatest thing ever, then the share price is going to go up a lot, which they have, and that's going to reflect this very rosy future. So what I would do is think about what people think lithium is going to do in the future and think about what are the risks. So literally sit there, and I think this is good for investing in anything, sit there and write down all the things that could go wrong. Well, one thing that could go wrong with lithium, and I'm not saying any of this will happen, is that a better technology other than batteries is created, right? So there are car companies like Toyota that think hydrogen's the future, right? And we just saw that in New South Wales, right? A lot of the stuff that Fortescue's doing, they're saying, no, I don't think batteries are the future. Like batteries catch on fire and they're big and they're heavy and they're hard to manufacture and you have to drag them around the cars. There's a brighter future. There's an alternative energy source to batteries. So I don't have an answer, right? But what I'm saying is remember there are risks associated with this and just look at whatever sort of rosy future or same thing. A lot of people get very negative about things. People got very negative about oil, right? When COVID started and oil futures were actually priced negatively, people said that, all right, well, we've got a couple of things happening. Everything's going to turn to batteries. Nobody's going anywhere because of COVID. Oil prices plummeted. Well, now they're up a lot, right? As reopening happened. So yeah, think about how much stuff changes. And in retrospect, it all seemingly makes sense. But at the time, people had very different views. Before that, if we look at oil, it was the world's running out of oil. Well, then they invented fracking. And whatever you think about fracking, US started being the biggest oil producer in the world again. That hadn't happened since way back in like Rockefeller days. Like technology changes a lot and things do happen. So just think about that. That's the risk with lithium. Is a very rosy future priced into it? And will that actually happen? Even if battery technology takes off, will it not be exactly what people think it will be in the future? Does it fall short of those expectations? And why does it do that? Is there an alternative that takes over? All right, let me get back to, I've gotten off track on my oil diatribe. All right, let's quickly go through some passive. So one of the questions we get a lot, and the reason why I wanted to talk about passive, is how do I pick a passive ETF, right? So we have analysts, we have a manager research team that looks at funds, ETFs, and LICs. Really passive, we're just talking about funds and ETFs, and rates them. And a big part of their rating is, of course, looking at the people from an active standpoint that are managing the money. They sit there and they interview them and they talk to them and they say, okay, do we think that this person has the experience, the process, everything else to make them a good person to actively manage your money? But the world has gone a lot more passive. So I want to talk a little bit about some of the different areas of passive. So what are you doing when you're investing in a passive fund? You are investing in an index. So what do you have to do? You have to look at that index. So what are we looking at here? Anytime we look at an index, we want to assess it on a couple different values. The next slide will get into what we should be looking for. What is the universe that this index is trying to represent? So for instance, if I want to invest in Australian shares, that is every share that trades in Australia. So when I start thinking about indexes on Australian shares, that's the universe, right? All of Australian shares. Index could be all global shares, all global bonds. So what is this index trying to represent? That's first. How selective is it to join the index? So if I look at the universe of Australian shares, and I look at an ASX 200 index fund, I can say, okay, how selective is it? Well, you have to be one of the 200 biggest companies in Australia. Then I start thinking about how many companies there are in Australia, and I can think about how selective it is. Weighting. Weighting is huge and underappreciated. How is the index weighted? So I've got 200 shares in the index, but how much do I put into each one of them? So the same decisions you're making, by the way, when buying a portfolio, when building your own portfolio. So weighting. So most indexes are market cap weighted, meaning big companies will represent more of the index. Well, that has a lot of implications. So it's important to look at weighting anytime you look at an index. So constraints. So constraints is an interesting one. Are there any sort of constraints to the weighting? So we see this a lot in like factor indexes and smaller indexes where they will say it's market cap weighted, but I won't let any company represent more than 5% of the index. So some indexes have those constraints. Some will say no constraints. And if one company becomes certain size, it could be 99% of the index, right? We'll just let that happen if the company grows big enough. So that's like, for instance, if you took Apple and you put it in Australia and then you created an index fund, well, Apple's worth more than all the shares in Australia, right? So if you took an index fund that was weighted of every single share in Australia and put Apple there, more than 50% would be in Apple. So that's an example. That's where there would be an unconstrained index that would let something like that happen. Rebalancing. So when is this index rebalanced? And is it rebalanced? So that is the mechanism of bringing something based on a constraint, for example, back into line. And remember, rebalancing are generally poor events for investors. There's tax consequences. All right. So what are good or bad things in our analyst point of view? And I'll go through these quickly because we are running out of time. Okay. So what do we want? We want a representative index. So of what we're trying to get, we would like the index to represent that underlying investment opportunity. So if I say that I want an Aussie shares index and I get an index that has 2 companies in it, that's not representative of how Australian shares are doing. So that's not good for me as an investor, because the whole reason I want to buy this index and not just buying individual shares, because I want something representative. It's this notion of buying the market. Don't go out there and pick individual shares, buy the market. Diversification. All right. How diversified is this index? So if you are an inclusive index, once again, it means that you represent more of the investable universe. It means you're not going to miss some big winner, which is what you don't want. Investable. So particularly when we look outside of large cap shares, so big companies, large capitalization companies, start getting into smaller companies, start get into some obscure markets, maybe some of the emerging markets where there's less interest. Certainly when we get into fixed income, if it's not investable, if it's not easy to go out there and buy shares, if it's less liquid, less share turnover is occurring, then that makes it a lot harder for the index provider, and those costs are going to be passed on to you. You have higher trading costs, bigger buy-sell spreads. You could have more tracking error, meaning that the investment vehicle, the ETF, if we're using that as an example, is not following the index because there's problems with when the index changes constituents. It's hard for me to go out there and buy that because there's not a lot of volume and the price can go up. That's bad for you as an investor. Simple and transparent. So the good example for this is like the Dow Jones. So the Dow Jones Industrial Average is quoted all the time. Dow Jones Industrial Average is like really screwy. And this has to do with Sensible as well, probably. But when they started it, what they wanted a transparent index. So remember, they started it back in like 1896, right? So there are no computers. So every day they were calculating this. So they calculated it off of price. So what that means is at the end of every day, they would sit there and they'd add up all the prices of, all the shares in the Dow Jones Industrial Average. So 30 of them. I don't know if it started with 30, but there's 30 now. They just add up all those prices and that would be the value of the index. Why did they do that? Because it was 1896. And there were no computers, and it was difficult to do a market capitalization weighted index. You just couldn't really do it. So that made sense, and that was transparent in 1896. It's not now. So that doesn't really make any sense. Transparent is also, how does something get into the index, right? The way stuff got into the Dow Jones back then and still now is a group of people sat in a room and decided what companies represented the American economy. Now that is very, very, there's wide latitude you can take when selecting those. So that's an example of something that is not transparent, not really sensible anymore. So transparent is the ASX 200, 200 biggest companies in Australia. Right? That's transparent, makes sense. Turnover conscious. So how much does this index change? So some indexes change a lot. Generally ones that are less transparent of why something goes in there. The FANG index, some of these Bitcoin indexes that came out. The index is changing a lot. What is wrong with that? It's all a cost to you. The trading cost of an index fund, replacing one share with another, there's lots of costs associated. They all get passed to you, whether it's the trading cost or it's the buy-sell spread every time they sell, whether it's the taxes get passed on to you as capital gains, all stuff that's in the index. All right. Sorry, we are out of time. Okay. Yeah, not sure why Facebook isn't. I'll send you an email, Paul. So thank you for that comment. Sorry, we are out of time, but thank you guys for joining in. So we'll be back next week. We're doing like International Week. So we're going to talk about global investing and we're going to talk about emerging markets next week. But anyway, thank you guys for joining. If anyone has any questions, you can send them directly to me at mark.lamonica1@morningstar.com. Carrie's saying, why do they still quote the Dow Jones index? People are used to it. But sorry, that's the last question we got to. But yeah, send through any questions and I'll get back to you later tonight. Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.